Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik, and in this video, we'll be looking at the liabilities and shareholders equity on a balance sheet and what they mean. This is the second video in my short video series on how to analyze a balance sheet. In the first video, we talked about the assets on a balance sheet and what each of the assets mean and how these can help us learn more about a business. Today, we're going to be talking about each of the liabilities and components of shareholder equity and what they mean and what they can tell us about a business and how we can use this information to make better investing decisions. The first section of the liabilities are called current liabilities, and these are debts and obligations that the company owes and are due within the next fiscal year. For this video, we're going to be looking at Johnson & Johnson's balance sheet so you can see what some of these line items look like in practice. The first current liability that is usually listed is called accounts payable, and this is money that is owed to suppliers that have provided goods and services to the company on credit. The next item is accrued expenses, and these are expenses that the company has incurred but hasn't yet been invoiced for or paid for. In the case of Johnson & Johnson, they break accrued expenses out into these various categories here. But unfortunately, accrued expenses and accounts payable don't really tell us all that much about the company's long-term prospects because remember, the balance sheet is just a snapshot in time. The next current liability is short-term debt, which is the money owed by the company and due within a year. Short-term debt is historically cheaper than long-term debt, which can get companies into a lot of trouble if they try to borrow short and lend long. This is most applicable to banks and other lending institutions, but if companies have lots of short-term debt relative to their long-term debt, this can be an issue if short-term rates rise substantially, which can happen from time to time. In the case of Johnson & Johnson, they account for short-term debt in this line item here, loans and notes payable. The next item is the long-term debt that is due within 1 year. This is also lumped in with loans and notes payable in the case of Johnson & Johnson. If a company does have a durable competitive advantage, they likely won't need to continually take on long-term debt to continue growing and prospering. So if we consistently see lots of long-term debt coming due each year, that's probably not the best sign for the long-term prospects of the business. This brings us to the total current liabilities, which is just the sum of the liabilities we have talked about so far. As mentioned before, this is the money that a company owes within the next year. The current ratio is a metric that can be used to calculate the liquidity of the company, and we find this metric by dividing current assets by current liabilities. Ideally, we want this metric to be greater than 1 because that means the company will not struggle to meet their short-term obligations to creditors. As I mentioned in the previous balance sheet video, the current ratio can sometimes be a bit misleading with fantastic companies. If a company has a very strong business model and earnings power, they don't necessarily need the liquidity cushion that a current ratio greater than 1 gives them. So it's good to understand the current ratio, but it's not necessarily the best metric to base your investment decision on if you are confident in other aspects of the business. Now we have come to long-term debt. This is debt that is due at any point greater than 1 year in the future. Generally, it is better to see companies with little long-term debt, as this means the company is sort of self-financing. And what I mean by this is that if they want to make acquisitions or invest into new segments of the business, they can just draw on the earnings power of the business to do that, rather than taking on debt to do that. Some industries, however, are very capital intensive and will likely require lots of debt to be successful, no matter how great the management is or how great the business is set up. This adds substantial risk to that business. Generally, a good rule of thumb is that a company should have net earnings that allow them to pay off all of their long-term debt within 3 or 4 years. In the case of Johnson & Johnson, they have long-term debt of a bit less than $29 billion, as we can see right here. In 2021, they earned $20.9 billion in net income, and they earned $14.7 billion in net income in 2020. So this means they could likely pay off all of their long-term debt within 2 years or less if they needed to, which is an awesome sign to see. The next liability is deferred income tax, and this is pretty simple. It's just tax that is due that hasn't been paid. Along with employee-related obligations, long-term taxes payable, and other liabilities, the deferred income tax metric doesn't really tell us all that much about the financial health of the company and the overall health of the business. Adding everything up that we have discussed so far gives us the total liabilities. Subtracting the total liabilities from the total assets gives us the net worth of a business, which is often called shareholders' equity or book value. Now let's see what makes up shareholders' equity. The first thing is going to be common and preferred stock. This is just the value of the common and preferred stock at par value. And usually par value is just something that the company decides, which is much lower than what the stock is actually worth. In the case of Johnson & Johnson, they only have common stock. They don't have any preferred stock. The absence of preferred stock for Johnson & Johnson is actually quite important to realize. Usually, preferred stock is really not advantageous for a company to have. Although it is equity and the company never has to pay back its shareholders like they would debt, preferred stock functions a bit like debt in the sense that dividends have to be paid out on a regular interval no matter what. And additionally, these dividends are not tax deductible like interest paid on debt is. So high quality companies with a durable competitive advantage tend to stay away from preferred stock because it's not as advantageous for them. And as we saw with Johnson & Johnson, like I mentioned, they do have no preferred stock, which is a good sign to see. Another item that Johnson & Johnson doesn't have on their balance sheet is additional paid-in capital. This is the difference between the par value of the stock and what the company sold the stock for. So if the par value of the stock is $1 per share, but the company sold it for $10 per share, then there will be a $9 per share line item carried on the balance sheet called additional paid-in capital. The next item here is accumulated comprehensive income or loss. This is basically unrealized gains or losses on some investments and hedging transactions. It's not included in net income because the gain or loss hasn't been realized yet. This can be used over time to predict if there will be any large threats or windfalls to net income if it is known what the loss or income will come from. In the case of Johnson & Johnson, the majority of the accumulated comprehensive loss we see here comes from foreign currency translation, and some of the loss also comes from employee benefit plans and hedging transactions, but this item doesn't really get all that important unless it's very large or very small. Retained earnings are the next item, and these are incredibly important. Each year, a company produces a certain amount of net income, which can be paid out as dividends, used to buy back shares, or retained to reinvest back into the company. The amount that is retained to reinvest back into the company is added each year to this retained earnings item. So, if we can see a company steadily grow this retained earnings number each year, this is a good sign that the company is steadily reinvesting back into their business and compounding your investment for you. This is definitely one of the most important numbers on the balance sheet, especially if we can see this number grow steadily over time. The final item here is treasury stock, or common stock held in treasury. When a company buys back shares, it can retain them as treasury stock with the option of reissuing them later on. The company can also cancel the shares, but it usually doesn't do that. Prosperous companies often have lots of cash on hand that they can use to buy back shares, thus making this treasury stock number very large. Oddly though, treasury stock is carried at a negative value on the balance sheet because it represents a reduction in shareholders' equity. Now we are back at the shareholders' equity, which allows us to calculate the return on shareholders' equity. We do this by dividing net income by the shareholders' equity. High returns on equity is what we are looking for here. The general rule is that over the long run, the company's stock will return about the same as the return on equity over that time period. The important thing to note here is that this is only going to be true in a very long time frame, say more than 20 or 30 years, maybe even more. So if a company has a return on equity for 10% over a 20 or 30 year time period, we can expect the stock to return about 10% as well. There's a few nuances here. If a company keeps buying back shares at a very rapid rate but doesn't grow earnings much, this will substantially increase the value of the treasury stock, which will in turn substantially decrease shareholders' equity and therefore inflate the return on equity. So watch out for this. If the return on equity looks high but the net income hasn't grown much, this could be a bad sign. And it's important here to focus on net income because this is the, bottom line number, whereas earnings per share is influenced by buybacks. Another thing that could happen is that a company could have negative shareholders' equity, which would actually give them a negative return on shareholders' equity. Now, one of the reasons that this can happen is that if a company buys back lots of stock, then this treasury stock value will be very large and the shareholders' equity will be negative because of that. And in this case, this is completely fine. However, you do want to watch out for companies that have negative shareholders' equity but haven't bought back much stock at all. There's certainly a lot more that I hope to learn about the balance sheet in the future, but I hope that this video helped provide a high-level view of how the various parts of the balance sheet interact. Let me know if you do have any questions down in the comments below. If you haven't seen the first video in this series where I cover the assets on the balance sheet, make sure to check it out up here. Thanks for watching, and I'll see you all in the next one.